Welcome to another real estate industry update. I'm Daniel Roccanti, and I'm here with Kyle Paxton. And today we're going to talk to you about special allocations and real estate partnerships and real estate funds. This is an important topic, very tax related for this one, so it can get a little complicated. But I think it gets really overlooked on why special allocations, especially in a partnership, are something that you should know if you don't know, because most real estate partnerships have some type of special allocation on the tax side, and that affects your K1 and how much income you get and things like that. So, why don't you go into a little bit of like what is a special allocation and why it's important?
Yeah, I'll try to stay a little bit, right? Because this is an easy topic to deep dive into. And we try to keep these videos relatively short. So, special allocations really drive real estate partnerships. I mean, this is a huge deal. We've talked about in some of our other videos, kind of the starting place in your investment into any sort of real estate is your basis in either the asset or a fund, right? And what having basis in these vehicles allows you to do is potentially get taxable losses allocated to you with accelerated depreciation. You're able to get money out of the fund without recognizing any sort of gain or anything of the sort. And so that's really the starting place. Is when you invest in something, you have basis in it, and now if you own a parcel of real estate yourself, or if you hold it in a partnership structure, there's a lot of flexibility in what you can do. So you'll notice we say a lot that you should only be holding real estate in a partnership as opposed to an S corporation, C corporation, another type of vehicle there. And the reason being with that is that partnerships allow us to do these things. So it allows us to make creative allocations of income between the different partners based on ownership percentages or what the operating agreement says.
Yeah,
So
it creates a lot of flexibility.
yeah,
So
a lot of flexibility.
corporations, whether it's S corp, C corp, all that, it's very structured, very good for operating companies,
Yeah.
you know. But partnership, there's more than just this, but it creates a lot of flexibility, which is what you need with real estate, because real estate just has a lot of complexity to it. You can basically accelerate depreciation for some partners and not other partners, things like that, especially when interests are different. You know, the GP's interest and the LP's interest are different. Okay. Did I put money into the partnership or did I not? Right? GPs are usually not putting money in or putting a small amount. LPs are the ones funding it. Okay. So they're the ones that basically have all the money in the company, and that really affects what these special allocations are that Kyle's going to go into more details.
Yeah, so for an easy example, just for fun here, if Daniel and I are in a 50-50 partnership and our operating agreement allows it, I put in $100,000 and Daniel's over there sitting on his hands not doing anything. If we create taxable losses, I want the taxable loss allocated to me, who's the one who put money in, has skin in the game, all that good stuff, as opposed to Daniel who's over there sitting on his hands. So that's what allows us to do these things, and it's all driven by the operating agreement. So if you have, I'm going to be talking about partnership structure, since that's, like we said, the most beneficial way to do this and allows us to do this special allocations. Your partnership should have an operating agreement, and the operating agreement allows you to make these allocations of income. If that doesn't exist and Daniel and I are 50-50 partners, we're allocating 50-50 every way, right? By default, because that's our ownership percentage, and we have nothing else that allows us to do anything otherwise. In partnerships, so long as your operating agreement spells it out and it is in line with substantial economic effect, which is really just the economics on how the fund or partnership is working, you can do whatever you want as long as it's within reason, again, following the economics there. So the operating agreement drives all of this.
Yep. And I know Kyle's going to get into this, but kind of like he was saying, like in the operating, we can write it up any way we want. You know, like we're 50-50 partners, but he puts all the money into the company. And you're probably thinking, how are you 50-50 partners? Well, maybe I'm bringing something to the table, you know, my expertise, my knowledge, my network, something that Kyle finds valuable. Okay. Because Kyle decided, hey, I want to be 50-50 partners with you, but I'll bring all the money. This is actually more common than you think it is. because someone's bringing the expertise, someone's bringing the network, someone's bringing the knowledge, and the other person has the cash. Okay. So it's like, it's still a 50-50 partnership, but now there's all these tax rules, and Kyle's going to go into like how 740B works and things in the IRS code and how that determines how these special allocations work.
Yeah. So like Daniel said, 704B governs this whole, I guess, concept, right? Special allocations. And so again, it gets back to substantial economic effects. So whatever we do within our partnership has to be in line with our operating agreement, which is in line with the actual economics of the deal. So if our partnership were to dissolve tomorrow, who actually gets paid out and how? What does that look like? And there's a whole separate set of capital accounts you have to maintain that, you kind of have your tax capital, which is driving how tax income and loss is being allocated. It is showing, your deductibility of certain things. Then there's kind of the economic capital account you have on what happens from a cash perspective if we shut this thing down tomorrow. So what the IRS is looking for when these are scrutinized is does basically what you're doing for tax purposes, how income's being special allocated for tax purposes. Does that actually align in some way with the economics of the deal? And that gets back to what Daniel's saying. You defend in that scenario that, sure, I put in the money, he's got the expertise, we wanted to give him a benefit, some sort of compensation from his work, so he's getting allocated income in this way, receiving the distributions, laying all that out gets you there. But
And
we
look,
are confined by that tax code. Sorry, Daniel. Go.
Interject a little bit on it because I want to go back to your example so we understand what 704B is and the substantial economic effect. So he put $100,000 into this company. I put zero, but we're 50-50 partners. The IRS in 704B basically says, I don't care what your intrinsic value is. Like, what really got put in this company? Really, Kyle put all the money in this company. And so because of that, let's say we go out there and we get losses, that basically says, all right, do we split the losses 50-50? Well, Daniel probably has no basis in this company because he didn't put anything in the company. I'm not going to lose anything. I have nothing technically to lose.
I have the skin in the game, right?
Right.
Is really what it comes down to.
Right. All your skin is in the game. We don't care about, basically me going out there and working really hard or using all that. We care at the end of the day, like cash and value. Okay. The true value. And that's kind of where 704B is. It's saying, hey, we have a loss. They didn't put nothing in the company. Kyle put 100%. Special allocation is probably necessary here to allocate all the losses to Kyle instead of 50.
Correct. Yeah. And so, we see this play out in a lot of different ways in real estate partnerships. It can be something, I see operating agreements all the time where it's depreciation specifically that is pulled out and said, okay, we are doing cost segregations. We're taking bonus depreciation on the properties that we're acquiring here. All of our partners have basis through qualified non-recourse debts. So the property is leveraged. It creates basis with the amount my limited partners have contributed in, plus their share of the liabilities. They can get tax liabilities taxable losses allocated against that. And so the big one, in talking in real estate funds, depreciation is the biggest buzzword, right? And so we see a lot these operating agreements specify depreciation in itself being allocated separately from other expense items based on whatever the set of criteria is. And so in that case, you break apart depreciation from the rest of the expense buckets, and it's treated in a different way in terms of how income is allocated to each of the partners across their K1s. Another example we see a lot is in preferred returns. So talking about kind of looking at waterfalls and how income that flows into real estate partnerships gets paid out. If you sell your property and then you're paying out, proceeds from the sale in a certain way based on your operating agreement, more often than not, the allocation of income, assuming it's a rental you've held long term, you have capital gain treatment, the provisions of our operating agreement make such that Daniel did all the work, so he gets $100K of the sale. I just give my money back and an extra $1,000. You would expect that the capital gain that's allocated to each of the partners follows along with the funds that are paid out. And so, again, that's what the special allocations here allow us to do. We're matching the economics of, okay, based on the operating agreement we put together, Daniel did all the work, he gets preferred return, whatever that actually looks like. And then these provisions just allow us to allocate the income to match that. So the person getting the money is also getting the associated taxable income and have that liability on the waterfall event.
Right. And it really comes back to that waterfall in your operating agreement. The waterfall is basically how all the incomes, deductions, distributions, how should that flow to the owners and partners? Okay. And then you have to throw 704B on top of that and say, all right, what's the actual true economic effect? Okay. Do we follow the water flow for this tax return, or do we have to deviate a little bit from it? It's all a timing difference. At the end of the day, your tax and your 704B at the end will match. The question just comes to how everything it might deviate during its existence, and it might never deviate. There's a lot of reasons why it doesn't, but that's the big thing with the special allocations. What does a waterfall say? What's the substantial economic effect? Is that going to require deviation? If it is, the goal is to get back to matching.
Yep. Fun stuff, keeps us employed. This is what we deal with all the time, right? It's a common. We'll talk about kind of risk and pitfalls here in a minute, but we see these. This is some of the biggest issues we deal with is allocation income and just following the economics and all that good stuff. The other one I want to touch on is on, and I kind of danced around this a little bit, but I do want to touch on actually like allocating losses in those basis limitations, right? So to Daniel's point before, if I don't have any skin in the game or I'm not on the hook for any of the liabilities within the partnership, I have no basis in that. And 704B is kind of overseeing that. Okay, I probably shouldn't get allocated any losses. So we'll see this sometimes where we start a real estate partnership with 3 partners, right? We're each 33%, just for use of round numbers, we each put in 100K. All of a sudden we're generating taxable losses with potentially we do a cost aggregation, create depreciation deductions. Maybe we're just operating as a loss in our rental property. And it comes to the point where someone has to put more money in to sustain this partnership. So maybe Daniel sits this one out. I put in another 100,000. The 100,000 everyone started with is now getting fully depleted. I put in another 100,000 there. So in that instance, it gets to where kind of we get back to the conversation on, okay, that extra $100,000 puts my skin back in the game, right? And so when before we were allocating our losses 33% because everyone had basis, we all started at the same place. Now I've created a spread there to where Daniel's basis may be 0. And, I'm now funding the losses in the partnership. And so then we have a special allocation of the taxable loss to kind of recognize that, right? So that's one we see quite often too in different partnership structures where you run into these certain basis limitations and have to tweak how income is being allocated. To Daniel's point, it's all a timing difference at the end of the day. And, if we go and sell the underlying property, then I'm going to have a bigger gain than Daniel does because I took more deductions against it. So, a lot of times this shakes out in a similar way, but, we roll forward these big old spreadsheets every year, calculating our basis, what's being limited, all that good stuff, so that we can make sure we true up all of these items based on the operating agreement if and when the waterfall event happens.
That's right. So what are some of the risks and pitfalls of your trial?
Yeah, the biggest one is the biggest one I see honestly is the just poor documentation of the partnership agreement. We get very boilerplate partnership agreements sometimes. Almost all of them have a whole section about special allocations, right? There is an entire multi-page section and almost every operating agreement we see about how income is allocated and what happens in those instances of no basis. It is very important to have those provisions reviewed by a CPA and make sure what you are communicating, especially in a fund structure, what you're communicating to your investors is actually what is happening in in the operating agreement and how it's listed. And, a lot of times there can be pitfalls in the wording in the operating agreement to where, you may be thinking you're investing on the day before year end and getting a big slice of depreciation, but the operating agreement says that all expense items are bifurcated based on the portion of the year you owned it. That's something we've seen where that all of a sudden you think you have a $50,000 taxable loss coming your way, and it's really $2,000, right? Because you only own the interest for a couple of days. So very important to, before the operating agreement is executed, sit down and say, hey, here's my intent. Here's how I'm going to get people to invest in this. Here's what we're thinking. And then, okay, did that actually translate into the operating agreement? That's a huge one. As tax preparers, when I'm going to prepare the tax return, I don't care if there's 2 partners or 150 partners involved in the partnership. I'm not doing anything without reading the operating agreement. So that's where I start. You can tell me whatever, and that's great. But we default to the operating agreement in these matters, because that ultimately governs what how we can allocate income within that specific partnership.
And that's important. I mean, it's the lifeblood of the partnership or the company. I mean, it's the governing document that everything is run by. It's whatever says in that operating agreement. You can say something by word of mouth. Oh, we'll do it this way. But if the operating agreement says something different, I mean, legally, you don't have any actual recourse. You both have to agree and hope that you'll keep your word. So it's important to look at your operating agreement. And if you want something changed, and you need to make an amendment to that operating agreement, a real amendment to it. And then now that's part of the operating agreement that needs to be followed. So anyone ever preparing your tax return, and you're doing some kind of real estate with partners, we always ask for our operating agreement, because we have to read that. Because without it, we don't actually know. We can basically decide what the default is, but
it could just be percentages, right?
Right. That's how most people default. Like, oh, you're 50-50 owners, everything's split 50-50. And I'm like, most likely, but I mean, if you're dealing with a complex partnership with a waterfall, I mean, it's definitely not that at that point. So it's just, when you're getting your tax prepared, it should always be reading over an operating agreement. Your CPA is not asking for an operating agreement, and you got a real estate partnership going on. That's an issue.
Yeah, and then the other big risk is just failing the economic test, and that your allocations aren't following substantial economic effect. So that's a big thing to look at. But I want to reemphasize too, like with this, there are risks and pitfalls, but special allocations are a good thing and a very beneficial thing for taxpayers, and very beneficial for the real estate space. Like the ability to do this within a partnership structure is incredibly valuable, and having a CPA kind of along your side, as whether you're investing in a real estate entity or you're managing a real estate entity yourself, having a CPA by your side to look at it and say, hey, this is what I would want to see in the operating agreement to benefit you. This is what I want to see in the operating agreement to benefit your investors, right? Our team looks at these things all the time, right? So to have someone in your corner who has experience with the risks and pitfalls and sees what makes these things successful, and then what's going to make my life easier to make your life easier when we prepare the tax return. Having an advisor by your side who has the knowledge and expertise to be able to do that is invaluable. And it's a lot less fun when we get brought in on the back end, when the problems arise, when we were consulted on the actual drafting of the agreement or whatever it is, right? So to the extent you can be proactive in this, it's massively beneficial.
It's just an easy way to get everyone what they want when their wants are different. Okay. I mean, if you have someone with a real estate professional status coming in with huge amounts of incomes from other sources, I mean, they're going to look at it as like, I want losses. I want losses more than I want cash right now. Right. So how can we accelerate their losses as soon as possible to offset that income? And then they might get less losses or more income in the future. So it all kind of temporary. It's just temporary. It all evens out at the end. But it's just a way to be like, all right, this person's, that's what they want. They're coming in this deal. Yes, we want a rate of return. We want our money back. But he's like, I care more about losses today. Let's get them more losses now. Special allocations, a partnership is just very flexible to be able to provide that.
All right, that's all I got. Daniel, if you don't have anything to add, get us out of here.
I think just the big thing with special allocations is just kind of, like realize that there's just a lot of flexibility. All right. Special allocations, all that means is, hey, does anything need to be allocated different than what your ownership percentage is? And it can be one item or two items. I mean, like he was saying, you could especially allocate depreciation, but everything else gets allocated based on ownership. So you can do a lot of different things. But at the end of the day, how the Irish Code is written is with the 704B, it has to be substantial economic effect. So it cannot go beyond that. Okay. So basically, this goes back to the idea like if you don't have any economic effect in here, like you don't have actually true losses, something you're going to lose, should you be allocated these losses? Most likely not. And even if you didn't do it right in the past. So we get this a lot of times with some of our clients. They come in, we look at it, and we're like, "Oof, no one read the operating agreement. No one did this right for years." It happens all the time.
Yeah,
especially
more often than I'd like. That's for sure.
Someone's just preparing tax returns and just doing it same old. It can always be fixed. You don't got to go back and amend all the tax returns. It's just, all right, what should it have been the entire time? And then there's a special allocation done that year to get it back. Sometimes it's unexpected and you might get more income than you were thinking, vice versa. But the reality is it can always be fixed by just getting it back on what is the economic effect here. And a nice special allocation is an easy way to do that instead of having to go back and amend tons of years of tax returns. And especially with how partnerships, with the whole audit regime thing that goes on. Nobody actually wants to audit a partnership or go back and amend a partnership who is under the partnership audit regime. So, I think that's all we have here today. So thank you for tuning in to today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Until then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.